Just about on Tuesday, April 22nd, 2014, you can see on this updated daily chart of the S&P 500 index that the broad market rally, which we saw really begin to materialize in the middle last week, continued to push higher yet today. The S&P is actually not far from all-time highs set earlier this month, intraday at 1897. We did close marginally off the highs today, and I think the lingering issue for the S&P is that we've had no 200-day moving average test, no 10% garden variety bull market correction going back to the year 2012. But on a standalone basis, of course, the S&P remains resilient. We have a pretty well-defined overall sideways consolidation. Bears failed to follow through last week to the downside when it looked like they had a golden opportunity to actually get us down to these longer-term moving averages. And of course, the S&P is in stark contrast to the leading parts of the market going back several quarters, if not years. That would be, of course, the biotechnology sector, looking at that ETF, the NASDAQ Composite, and the Russell 2000 indices. Now, it's not just the S&P, of course. It's the Dow Jones Industrial Average, and indeed, many of the defensive parts of the market, the utilities, consumer staples, even energy and materials of late also have been kind of benefiting from sector rotations. With respect to the Dow Jones Industrial Average, just like the S&P, on a standalone basis, it's pretty impressive, resilient. Bears have been unable to sink their claws, especially last week or the week before, into the Dow, and that continues to point to more resilience and more maybe a place for fund managers to find some safety in the stodgy, low-growth mega caps with the yield, but it simply is what it is. So you compare and contrast the Dow and the S&P, near recent all-time highs, resilient as can be, versus the NASDAQ. And again, the NASDAQ had a pretty good day today, but we still have lingering issues. First and foremost, all this buying power has been used up over the past week or so to get us from the 200-day moving average simply up to the 100-day moving average, and we did not get a close above it. So that's a short-term level to watch, this whitish, kind of grayish line on my chart. Kind of an overlooked moving average. I think the broader issue for swing traders is this. The NASDAQ, despite this recent exhilarating rally, is still in a pattern since early March of lower highs and lower lows the whole way down. So this swing high up at 4,185, that's probably your next level above the 100-day moving average. Tomorrow, in the short term, I would definitely be watching those levels above. And then comes really the big kahuna test if bulls are going to bounce us even higher. That would, of course, be the 50-day moving average. It's still slightly rising, but it's bound to smooth out if bulls don't immediately recapture it. So this is definitely a high-stakes kind of scenario here. The weekly chart, again, we still have a breached rising channel. I know if depending on your interpretation of it, we may have kind of closed back inside the channel today. Still, there's a lot of work to do to undo a busted rising channel this steep, going back to November 2012. You probably need to see, it's not enough oftentimes just to throw back into the channel. You have to hold it and then go immediately to the top. That's usually the way that bulls can kind of crack any damage done. So again, really interesting times for the leaders in the market. And remember, we're not that far from May now. May, not the greatest seasonality. We'll see how that holds up this year. Russell 2000, pretty much the exact line of analysis as I did with the NASDAQ. 200 to 100 day over the past week. A lot of buying power used up. And this swing high up at 1,160, that's probably going to be your next level to observe before the 50-day moving average. So those are your leaders. Same kind of thing with the longer-term rising channel. Biotech's another very good day, bouncing well below the 200-day moving average, still bouncing up. And yet, you can see there's still a lot of damage here to pretty much undo. If you bought back here in February, you're still underwater on your position. You would think overhead supply is likely to matter for the biotechs. After the bell, I think Amgen missed and Gilead beat, so we'll see how those guys react tomorrow. Again, biotechs, understand the quarterly chart here. Here's the IBB quarterly, massive shooting star for the first quarter of this year. After a very steep run-up, this month we're getting a lot of volatility. So again, high stakes here. We'll see if bulls can overtake 245 to the upside. That'd be, I think, a very good step if they could do that. If not, again, you still want to presume that the risk still is maybe we go back, test the lows, or push lower yet. But this quarterly chart really is a doozy. If you believe in candlestick analysis, you can see a sharp run-up, and then again, the first quarter this year, big shooting star, which puts us on watch for a downside reversal, even with this initial volatility there. So those are your leaders. Still not out of the woods with the leaders. They're still in this overall pattern, lower highs and lower lows going back a couple of weeks, if not months. The NASDAQ, the Russell, and the biotechs. Therefore, again, let's see what bulls can do. You do have names like, or sectors like the transports, which just remain resilient as can be. I tend to think we've pretty much seen the last gasp. Union Pacific, we shorted this move, got out of the way before earnings. Now I'm looking to short it again, especially after this kind of a candlestick. I'm still inclined to think this is a long topping process for Union Pacific. You can see the run up here on its own quarterly chart. The monthly chart, Union Pacific, a bunch of these transports, still very steep here. So again, I'm not inclined to think another healthy leg higher is imminent or in the cards. Financials, decent day, didn't break down yet. JP Morgan, still though, I want to see more. I'm not assuming that bulls are back in control with the financials. Bank of America, Citigroup, Goldman, they're hanging. They're trying to hold the line. They're trying to hang in there. Nevertheless, I'm not overly impressed. And I really wasn't overly impressed with the price action today. I just think you're seeing some really damaged tech stocks at least stop going down for now. Now, as far as the leaders are concerned, Amazon has earnings coming up, so it's kind of a stalemate here. I probably would not be playing Amazon in front of earnings, but still, you can see the damage that's been sustained here. Facebook, Facebook, Tesla acting well. Zillow, pointing this out. Zillow and Tesla are probably the two of the better leaders in the market. Technically, Tesla, I think, has earnings coming up maybe in early May. But again, names like Facebook, even though it's been strong of late, still it's going to have to contend with the mid to upper 60s and 70s. That's where the real battle is going to be faced there. Netflix, again, big, exhilarating, earnings pop higher. I talked about this concept, and now the dust is going to settle. And when the dust settles, Netflix now has a clearly declining 50-day moving average, and it definitely suffered a lot of damage. So compare and contrast. Sure, you can get excited about the Netflix beat, and if you just entered Netflix and played calls into earnings, congratulations, that's a great trade. If, however, you bought Netflix up here and you wrote it down, and now you're celebrating, keep in mind there's a lot of work to do to get back. It's a drop in the bucket compared to this decline going back to March. Again, try to be objective here. Declining 50-day moving average for Netflix. A lot of issues for Netflix longer term, in my view. It's had a terrific run. But in my view, it probably needs some time to digest and heal. Priceline.com, similar comments apply. Again, been resilient of late. Bulls will probably argue, well, here we go, a downtrend breach. That's all fine and great, but there's still a lot of work to do. Apple, again, green today. Still, I'm inclined to think Apple's kind of a dead money stock overall. I don't have a position on either way, but I do think Apple is transitioning from growth to value name, not unlike what we saw with Microsoft after turn of the century over the past, 2 decades or so. So just keep that in mind. I'm not looking for Apple to be a growth leader in the tape anytime soon. There again, just kind of whip through these leading names. Google, point out descending triangle, still not healed even though it was green today. That's pretty much the take home point. Natty Gas, I'm long here, still over 26.50 on the UNG ETF. Probably could move higher yet. Crude, not a good day today, still working through a long consolidation. I do favor Natty over crude and have in the short term, and still do at this point. Coffee, JO, again, it's had a monstrous run-up. I know the temptation is to lay off the action, but still, this could easily just be day one out of a cup and handle consolidation spanning many, many weeks. Therefore, I am kind of taking that seriously. This could be another move higher. Keep an eye on sugar as far as soft's concerned. Above 57, 58 did hold support. Cocoa here, nib, but it's very thin. It's got to get going again to the upside. Corn, just a sloppy mess. Watch it above 35. This was some kind of flash crash or something. And again, take all these soft commodities with a grain of salt if you're trading the ETN. But simply put it, they are what they are. Wheat, watch it above 17. Other parts of the tape to observe as far as commodities, intermarket. Again, gold miners, I pointed out yesterday, maybe this is a bear trap. We need more evidence. I don't want to be one of these blind, complacent gold bugs. I'm not. I'm just kind of calling it like I see it. Yesterday, intraday upside reversal. Today, modest upside follow through. But the juniors, GDXJ, did get a nice move up through 35. That was the first level I was looking for off yesterday's reversal. So, so far so good. You take these things one step at a time when you're dealing with the commodities complex. I mean, of all the places to be a cowboy or a hero, I mean, you can take your shots, you're taking on risk, but the commodity complex, especially the precious metals and miners, are not the spot to be, kind of a wild cowboy. You always want to consider your risk. You don't assume that every trade you make is going to be right. In fact, you assume it's going to be wrong, and then if you're right, you're pleasantly surprised, and I think you deal with it then. The GDX, I still am operating under the long-term bullish RSI divergences building, but this could be a big bottoming pattern. Again, this area has to hold. If it doesn't hold, that's it. I don't mind kind of walking away, maybe even flipping to the short side. That's, I think, the mentality you have to have. Are there a bunch of other things? Sure, I could say a weekly or a daily chart golden cross here, the 50-day moving average, the dark blue line up through the yellow line, 200-day. That's what's known as a golden cross. If you're a bull, that's what you want to see, but it's not enough. You have to get the price confirmation, and I would argue you got to get it imminently. Gold bulls, silver bulls, gold miner bulls, silver miner bulls, they have to get the job done now. Not, in a couple weeks, not in a couple months, now. Silver, again, the job done. Upside reversal above, closing at 1870. Now, silver's been the weak sister in the group, a problem, a drag. You've heard me argue that. It's in this massive descending triangle going back to the summer 2013. However, a descending triangle can often be a bearish pattern. The presumption is it breaks lower. But when you see it occur after a prior steep downtrend, now you got to be a little more nuanced than that, because oftentimes it can actually mean a kind of a bottoming pattern, a bottoming descending triangle. So 1870 back above 19, I think would be ideal for silver bulls. But silver bulls, again, have to get the job done here. If not, you cannot be stubborn. You got to step out of the way, or you flip short. I think that's pretty much how you look at it if you're a gold bull. GLD, though, the whole time never lost 122.50, which was the neckline from this left shoulder head right shoulder going back to last winter, last New Year's Eve, and then last early winter. So again, modest upside reversal in GLD today. Once again, the taking is for the gold bulls. Golden cross here, 50 over to 200 days. So again, we're going to see how this plays out. But I think, once again, gold bulls, silver bulls, miners bulls, they have their setup. And the issue is whether they can arrive and kind of seal the deal. Bonds flip green today. Still, this bearish engulfing candle from last Thursday, it's actually still in play. So I think, again, the bond market's at a really interesting juncture. Sooner or later, I am looking for these bonds to kind of roll over. Still declining. Actually, the 200-day moving average starting to smooth out here, but basically, I still think bonds are at a really interesting spot here after a spirited rally over the past couple of months. Again, there's no room, I think, for being dogmatic in a bunch of these intermarket ideas. Some individual plays, Skull Candy might get something going if it can crack $9 to the upside. Had a member point that out in the room earlier today. I mean, the energy stocks, I think it's pretty obvious at this point. They've been benefiting from rotation. I wouldn't be surprised if they kind of come back in. They are quite extended away from the 200-day moving average. So again, overall, I didn't chart GDP last night. No trigger, high type bull flag in the energy patch. This is a heavily shorted issue. So we get another rally over 25 or 25.25. You can take a shot at GDP on the long side for a short squeeze play. But I'm actually more focused on the intermarket opportunities. And remember, last week I did cover my swing shorts inside 12631 right around that big reversal day. Last Tuesday or Wednesday, as far as the NASDAQ and the S&P were concerned. Once I saw we weren't immediately going to, last Tuesday, I believe, once I saw we weren't immediately going to plow through, I covered the rest of my swing shorts. We had nice cushion on them, locked out a bunch of nice wins. I have not been swing short selling ever since overnight. With the NASDAQ, especially with these leaders. We wanted to give them room to bounce. And now what I'm saying is I'm starting to entertain the idea that we could be rolling over again, but I need to see actual proof. Remember, if you had that mentality in 2013 that we simply must check back and roll back over. You got ran over. The market kept V-shaping up. Now, I'm not convinced this is 2013 yet. I don't think that necessarily is going to happen, but still, I'm going to be flexible enough not to get run over. Either way, whatever the outcome is. I'm not betting on a V-shaped rally, but if it does happen, I won't get run over. And if we do roll back over, then at a minimum, I'll be protected in heavy cash. Focus on intermarket opportunities. We'll see how those play out. But I would be looking, again, on the short side now if we see the NASDAQ start to get rejected away from the 100-day moving average, the Russell, again, from the 100-day, and the biotechs, again, little room to pop tomorrow, but still with a declining 50-day moving average. The presumption is rallies are still suspect in the biotechs. They were badly beaten down. Now they're getting a check back. We'll see if they make it all the way up there. But the 100-day and the 50-day, those are your ideal targets if you are looking to kind of look at on the short side again. Again, BIZ, the ultra short biotech ETF. Again, it looks like it looks horrible, but the fact of the matter is, if the biotechs, the IBB, if it does check back to the 100-day or the 50-day, it has suffered technical damage, and in my view, that damage has not been healed yet. Again, I showed you that longer-term chart. So again, I'm still operating under the thesis the leaders are still in correction mode, even with the recent snapback rallies. Therefore, I'm largely defensive, looking at intermarket opportunities, and until I see more evidence that the leaders are healed here, I'm going to continue to go with that. Hope you enjoyed this video. Hope you're enjoying my blog post. Have a great evening.